So here we can see we are going to cover, according to the accounting cycle, this is how we're going to cover this information in the upcoming chapters. This information we're going to cover in Chapter 2, Chapter 3, and Chapter 4. So in Chapter 2, we're going to focus on analyzing the business transaction, recording it to the journal, posting it to the ledger, and creating the unadjusted trial balance. Okay. When we get to chapter 3, we're going to focus on recording the adjustments to the journal, the adjustments, copying those adjustments to the ledger, and then creating the adjusted trial balance. And then in chapter 4, we're going to focus on the financial statements and then closing out our temporary accounts. Each one depends on the other for information. So we're building up. The climactic point is chapter 4, where we will then take a look at and create the whole accounting cycle. Analyze, record, post, create, record, post, create, create, report, record, post, create. So with that being said, we talked about how to use the T account or how the tool is supposed to work. Let's see it in action. When using the T account tool, we must use the following. We have to identify the business transaction, identify the accounts impacted. There are at least two accounts impacted. Sometimes there's more, but at least two. And then we must decide, are those accounts that are impacted, those two accounts that are impacted, are they increasing or are they decreasing in value? Once we do that, we will use the T account to show the increase or decrease of that particular account. So step 1, analyze the transactions in the source documentation. So we make sure that we have the receipt from the sale. We have, or the purchase. We make sure we have any documentation that makes the purchase or sale relevant, whatever that business transaction is, and that it is a source documentation that proved that this happened and these are the amounts and these are the dates and times that this took place. Once we've analyzed the transaction, then we say, what are those two accounts impacted? And then once we said, well, what are the two accounts impacted? Are they increasing or are they decreasing? And then we say, let's use that handy dandy T account to determine what side that increase or decrease is taking place on. Now that I have fully organized the increase or decrease, because again, we're accounting is just high level organization, because we've now organized it, the increase or decrease based on the side, we can now record it into the journal, and then, which is our part of record, remember that? So this right here, the first 1 to 2 steps here, that was identify. Remember we talked about that. What is accounting? It is a system that identifies, then we record, and then when we post that information to the ledger, that's storing it. All right. So when we are recording or journalizing these transactions to the journal, we have to make sure that we record the date, the two accounts impacted, sometimes there's more, the value of those to determine if the account is increasing or decreasing, and then based on the increase or decrease, we record the value on the appropriate side. So cash, according to the T account, increases on the debit side. So that's why it's debited. Common stock is also increasing, but because it's on the right-hand side of the equal sign, it increases on the right-hand side of common stock, which is credit. And so thus we have the proper recording of this transaction for December the 1st. Once we have successfully recorded that information to the journal, we must store that data, the date, the accounts increasing and decreasing. We must store that data to the ledger. And what we use is what we called a ledger account that shows the date that, in this case, cash was either increasing or decreasing, and what was the final balance. So notice on the first it increased by $30,000. So how much was in the cash account? 30,000. Well, on the second we used cash to purchase supplies. So it decreased by 2,500. Well, what was left in the cash account? 27,500. We purchased equipment. So cash decreased again, 26,000. What was left in the account? Only 1,500. And so then we made a sale, a customer paid us, and so cash increased by how much? 4,200. So what was the ending balance? 5,700. So notice we have the date, we have the explanation as to what took place on that date, and then we record if the account increased or decreased in its ending balance. So notice how this information is copied or posted over into from the place that we record it to the place that we store it. So we see where the date goes there. We see where the value that the account increased or decreased by, in this case, it increased. And the reference number is the page. So notice G1 represents General Journal page 1. And then we show if the account increased or decreased, and then what is its balance. And then to verify that that account was successfully copied from the journal to the ledger, which is what this is, we copy the account number to the journal. So let's take a look. Value Consulting has the following accounts in its ledger: cash, accounts receivable, supplies. So it gives us all of the accounts. And what they want us to do is take a look at each one of these transactions that happened in the month of July, and they want us to record these transactions to the journal. Record them to the journal. So the first one we say that we paid rent for the month, 3,200. So what are the two counts impacted? Paid says cash, right? So cash is one of them. And then the other account is what? Rent. Rent expense. So the question is cash increasing or decreasing in my business? It's decreasing. Cash is going out to pay the rent. Are my expenses in my business increasing or decreasing? Well, I just added another expense where I didn't have one before. So my expenses are increasing. Remember, expenses are always increasing. Anytime an expense takes place, it is increasing your expenses. Okay? So now, using the T accounts, we need to determine where do we show this $3,200 decrease in cash. So if you look at the T account, remember cash is an asset and it's on the left-hand side of the equal sign, so it increases on the left-hand side. So we would say that this account decrease will be recorded on the debit side. Rent expense is increasing. So remember, rent expense is on the other side of the equation. It's over here. However, remember, expense is one of those exception accounts. It does not increase on the right-hand side like everyone else does. It increases on the, oh, I'm sorry, I misspoke my information here. Ooh, you guys are going to hate me. Eraser. This account is decreasing. My apologies. And so this account is decreasing on this side. What was I thinking? Whew. All right, and so here it decreases on the credit side, the right-hand side. So my apologies. Credit. And if you caught it, good job. You got it. You understand it. Woohoo! And remember, expenses are always increasing. Anytime they incur, it's increasing what you got to pay out. And remember, because it is the opposite of everything else that takes place on the right hand side, it increases with a debit. And so we put debit. All right. Now, one thing that I want you to remember here, here's a little note. You can, if you have two accounts, only one can be a credit and only one can be a debit. They cannot both be credits and they cannot both be debits. Debits and credits must balance. Okay, you cannot have more credits than debits in a recording of a transaction. All right, so what does this look like? So notice here, this is the one we just looked at. We record rent expense first because it's debited. We always list debits first. So another point here, debits always listed first. All right, so we list them first. Then notice that we indent the credit, the account that's being credited, 3,200. It does not line up. Notice there's a dent there. All right. So that means credits listed last. So let's take a look at this one. Paid advertising. What are the two accounts impacted here? Cash and advertising expense. So advertising expense. Is cash increasing or decreasing in my business? It is decreasing. Are my expenses increasing or decreasing? They are increasing. All right, so what side does an asset decrease on? It is the credit side. All right, what is the side that an expense increases on? It is the debit side. So now that I know that I will show cash's decrease on the credit side and advertising expense increases on the debit side, I'll record it to the journal. So I put in the date that it took place on. I list the account that's being debited first, 750. So this is the debit column, left, and this is the right column, credit. And then the account that's being credited is listed last, and I put the value that it's being credited for here in the credit column. All right, next one, paid cash for supplies. So what are the two accounts impacted here? Cash and supplies. Is cash increasing or decreasing in my business? It's decreasing. Why? Because it's purchasing supplies. Supplies, is it increasing or decreasing in my business? It's increasing. Okay, cash is an asset. It's decreasing. What side do we show that the asset is decreasing on? The credit side. Supplies is an asset and it's increasing. So what side do we show that it's increasing on? The debit side. So remember, it's an asset. So we record that in the journal. So we put the date. So the account that's being debited is listed first. So supplies, 1,300. Cash is decreasing. It decreases on the right hand side, the credit side. So we put the 1,300 on the credit column. All right, purchased office equipment on account. Did we use cash? No, we purchased on a line of credit. So what are the two accounts impacted here? Office equipment and debt, accounts payable. So is office equipment increasing or decreasing my business? It's increasing because I didn't have equipment before and now I do. Accounts payable, is my debt increasing or decreasing? It's increasing because I use debt to make the purchase. So both of them are increasing, but they increase on two different sides. Office equipment is an asset, and assets increase on the debit side. So that account will be debited for $12,500. Accounts payable is a liability. It increases on the credit side. So this account will be credited. And so that's what we put here. The date that this happened, office equipment is increasing. Increases on the debit side, the left-hand side. Accounts payable is also increasing, but it increases on the right-hand side, the credit side. Next, we have received cash from customers on account. So in this situation, what are the two accounts impacted here? Well, cash is definitely being impacted because it says we received the cash. And then from customers on account. So these are customers that owe you money. Excuse me, and now they're paying you. So when a customer owes you money, that's accounts receivable. You're waiting to receive this. So these are the two accounts impacted. Is your cash in your business increasing or decreasing? Well, it's increasing because they paid us. The customer paid us. What about accounts receivable? It's decreasing. Why? Because the customer paid you and they no longer owe you $11,400. So cash is an asset. Assets increase on the debit side. Accounts receivable is also an asset, but it's decreasing, and that decreases on the credit side. And so thus we put in the date. We list the account that's being debited first, the account that's being credited last, and the value that they're increasing and decreasing by. Next one, paid creditor. So cash is involved, and we're paying the who on account? The creditor on account. So cash. And what is creditor on accounts? That's accounts payable. So we are paying down some of our debt. So is cash increasing or decreasing in the business? It's decreasing. Is accounts payable increasing or decreasing in the business? It's also decreasing. So they're both decreasing. However, they decrease on two different sides. Cash is an asset. It decreases on the credit side. Accounts payable is a liability, and it decreases on the debit side. So when we go over here, we put in the date that this transaction happened. Accounts payable is being debited, $11.75, and cash is decreasing, so it's being credited for the same amount. Guys, getting the hang of this? You should be. Paid cash for repairs to office equipment, so cash and repair expense. Cash is decreasing, money going out. Expenses are increasing. Cash decreases on the credit side. Expenses always increase, and they increase on the debit side. So that's what we see here. Miscellaneous, they call it miscellaneous expense. So, and then cash. You guys seeing that? So that's how we treat these. You find the two accounts that are impacted, and guess what? You're not going to get this from just looking at this video. This is where the practice comes in. You have to practice this. That's how you become acclimated to it and comfortable with the terminology and how this works. So paid telephone, that's cash, and telephone expense or utility expense is an expense account of some sort. Fees earned is revenue. And billed to customers for the month, fees earned and billed. So did we get paid? No. So accounts receivable. Is my revenue increasing or decreasing? It's always increasing. What about accounts receivable? Well, in this case, it's increasing because I'm waiting to receive this $33,760. Revenue increases on the credit side. Accounts receivable increases on the debit side. So when you take a look at that, that's where you have here the 31st that took place. And so paid electricity, so cash, and the utility bill, so it's utility expense. And here is cash and dividends. Cash is the account. Dividends is the second account. Is cash increasing or decreasing? It's decreasing because money's going out to pay, so it decreases on the credit side. Dividends is increasing. It always increases. It never decreases. So it increases on which side? The debit side. Remember, it's the same like an expense. It is the exception. So that's what we see there. All right.